being retired, 75 or 80, and looking at your bank statement and going, when's my next Social Security check coming? 77% of Americans depend on Social Security, but it only funds 26% of their retirement. So a lot of people are in a hurting position. So Andy said to me, he says, Tom, can I afford to retire? So I said, Andrew, basically, Andrew's situation was this. Extremely conservative. Kind of these clients that getting them out of cash is pulling his leg, but convinced the market was going low, extremely conservative, wanted to be in cash. Based on his current financial situation, can Andrew and his wife retire? Well, what I do is what I always do is I sent him the questionnaire, and he fills out the questionnaire. He sent it back. Mallory dropped it into the software program that we use, the financial planning software that we use at the firm, and this is what happened. The software comes up with a pie chart. His risk level score was number 1. That's the lowest score you can have, the most risk-adverse score. And basically putting 67% of his money in bonds and 20% of his money in stocks and then 5% in cash. His capital preservation level was 1. But guess what? Andrew, I got bad news for you. Based on the Monte Carlo simulation, which I'll explain briefly, nope, you can't afford to retire. Why? Because his risk tolerance was too conservative. I said, Andrew, you got to take more risk if you're going to have enough money when you're 80 or 90. He said, okay, well, what do you recommend? I said, well, let's play around a little bit. What if we invested 100% of your money in the S&P 500? A lot more risk, a lot more growth, and a lot more risk. Okay, so we did that. And here's what happened. We had a 68% probability of success. Better than his first plan, but here's the problem. His bear market scenario failed. Well, this is actually below confidence too. So the S&P 500 gave him a lot more growth, but the volatility of return was way too high. So if we went into a bear market, he would basically fail. Now let me explain Monte Carlo. Monte Carlo simulates 1,000 years of returns, and it looks at the sequence of returns. So let me explain that very basically. Here's an example of 2 clients retiring both with $1 million. Client A and client B. However, client A, the stock market has done pretty well in early years of retirement. Client B, stock market hasn't done very well. Client B, because the stock market didn't do well in the early years of retirement, ends up being out of money at 81. Where client A, see the sequence of returns, actually at 95 still have 3.9 million. So what Monte Carlo simply does, ladies and gentlemen, is it looks at the standard deviation of return, the volatility of return, and it looks at the average mean return, and it runs it through the laws of statistics to give you the probability of retiring. So the next thing I told Andrew was, I said, Andrew, let's look at a 60-40. 60-40 based on the work of Dr. Markowitz and Dr. Sharp, won the Nobel Prize for modern portfolio theory, said this is the best place you can invest your money. So we ran it, and guess what? I said, Andrew, if you put your money 60% stock, 40% bonds, you have an 84% chance that you'll be able to, your money will live longer than you. Good. But guess what? When I ran the Monte Carlo, the bear market, in other words, that sequence of return, there's a 64 and a 57% chance, needs and wants, needs only, that the plan is going to fail. So I said, Andrew, if things work out, you're good. But if things don't work out and you're unlucky, you're SOL. And not only that, here's what's really interesting. Remember, the 60-40 is based on the fact that bonds balance out the volatility of stocks. And we've been in a bull market in bonds because when interest rates go down, bonds go up. So think about this. If I have a volatile stock market and I have a sort of this bond, which is a parachute, it dampens my volatility because I'm getting that return in that stocks. But if we're going to be in a long-term trend of raising rates and bonds don't give me that cushion, then I think the 60-40 going forward may even be worse. But the bottom line is, at 84% confidence, that was good. Bear market scenario, that was bad. I said, it's a towing cost. 57, 64%. Wasn't really happy with that. So then he said to me, Don, let me ask you a question. Interest rates are 5% right now. I said, yeah, they're actually a little bit higher. I could do a one-year T-bill 5.25%, right, Pat? Box at 5.5%, 1 year. I could do better than 5. He says, Don, what if you ran the plan where we assumed I'm making 5% for the next 30 years of my life? Will I succeed? Nope. Zero chance of success. Why? No risk, not enough return. So there's this problem that financial planners have, is that clients want to be conservative, but they're not going to get enough growth. So then I said to him, let's think outside the box. We're really good at that, right, Pat? We're really good at thinking outside the box. So I said, let's do this. What if we took, first of all, we got interest rates that are basically at a 16-year, 20-year high. Okay. So, and let's say I can get 5.5% on a T-bill. Let's say even 5%. And by the way, sidebar, just as a sidebar, how do banks make money? John, you go to the bank, you put money in a CD, okay? They take your CD and they buy a treasury bill. And they make the difference. Now, this is about the stupidest thing that anybody could do, because why? Because you can call Mallory, this is Mallory, and you say, hey, could you buy me a treasury bill? Yes, and we don't charge you any commissions or fees. We're not managing that. We only charge if we manage money. Just call us up and Pat will put in the order for the T-bill and put it in your account. So why would anybody in this room own a CD? It doesn't make any sense, because banks are just buying T-bills and they're making the difference. It doesn't make any sense to me why anybody would buy a CD. So anyway, let's get back to outside the box thinking. So I just steal the treasury from the bond, and let's say 94, 95%. I take the difference. I invested in the S&P. I invested in a leveraged S&P instrument. And guess what happened? 95% confidence zone. His plan succeeded. Wow. Wow. And so I said, Andrew, you can retire if we use something called an index treasury note. And why? Because I'm getting the upside of the market, but I'm not getting any of the downside of the market. I'm just stealing the interest and using the interest to leverage the upside. Okay, I'm getting my cake and eat it too. Market crashes, he loses nothing. Market goes up. So in conclusion, cash is not a retirement strategy. Investing 100% in the stock market was too volatile. 60-40 did work, but in a bear market scenario, if a sequence of returns turned out to be where you retired just before an 08 crisis, was bad. It's not the return on your money, it's the volatility of return on your money that grows wealth. Invest in treasuries and play with the interest. That's right out of the Buffett playbook. That's a Warren Buffett strategy through and through. 96% confidence zone. And the interesting thing, it's gotten better. Interest rates are higher. So where I wrote the article, it was 50% participation. Today, it's 60%. Now, when I run historical regression, I said, Pat, if I did an index treasury note over the last 30 years, how would have I compared? Well, this is how I compared. Question, ladies and gentlemen, what investment on this list has absolutely no risk if you hold it for 1 year? The one that's paying the highest? That doesn't usually work that way. Wait a minute. The investment that's paying the most is the safest? Yes. So, hello? What am I missing here? Okay, so now, am I in this? Are you guys in this? Okay, I'm not in this. I'm in these. Why am I in these? In fact, most of the people in the room are in these. Now, why? Well, number one, because I basically am saying I'm willing to give up some risk on the downside to get more return on the upside. Why am I willing to do that? Because I'm cutting off my tail. Rick, I'm cutting off my first 1.5 deviations, essentially, is what it usually comes out to. And I'm participating right from $1 on the first 1.5 deviations. So I'm really skewing the risk-return profile. And so what happens is if the market's down 25, I'm down 5. If the market's up 25, I'm up 18 3/4. Now, when I did a regression on this, if held to maturity, this is 100% guaranteed. When I did a regression on this, look at this. Look at this. I blew out the stock market, the S&P. I blew out the 60-40. Of course, I blew out the 10-year. But look at the return of this investment, almost 9%, over 9% a year on average. And yes, there is risk introduced, because if I break that 20% zone, I am going to start to lose money. But look what happens. I could rebuy the market a lot lower, and when the market bounces, I actually beat all the other investments. So the bottom line is, has a little bit more risk, but I think the risk is de minimis. This is much less risk, but I must tell you, I have a lot of clients that called me up at the beginning of the year and said, I don't want to be in the market. I go, yes, but you don't want to be in cash. Well, Dom, can I get market returns without any risk? Yes, I can give you that. And I do have a good number of clients in this. But I still like this, the absolute returns in this. A lot of my clients are in this. And so, as you know, some clients are in some of our other products. But anyway, just thinking outside the box.